What the results reflect, obviously, is a very strong market, but more importantly, it reflects the hard work the organization's been engaged in over the last several years. We've restructured significantly. We've taken out $6 billion of structural costs since 2019. And as you recall, back in 2018 on your show, we talked about the underinvestment we were seeing in the industry and Exxon Mobil's decision to lean into the business and to make investments across the Gulf Coast and around the world and additional production capacity when most of our peers were leaning out of the industry. And we anticipated tight markets at some point coming forward and wanted to be prepared for those. And what we're seeing today is with that extra production that we invested in 5 years ago and since then, that we're in a position to bring more product to market.
I didn't realize that profits were bad. Basically a company can't function if it doesn't profit. And who gets the profits? Well, the people who work for the company and the shareholders of the company. And the shareholders happen to be public pension plans to the extent they aren't towing the ESG line relative to oil companies. But it's just a lot of hypocrisy to be attacking the fact that these oil companies are suddenly making money when 2 years ago they were losing a lot of money. And maybe 3 years from now, they'll lose money again.
It would be wrong as at the same time that you're asking these energy companies to invest in a new energy economy, to invest in new drilling, new investment. If you start just focusing on one quarter saying, see, it's all their fault, I think you really miss the bigger picture. And I think it's really important that we start talking about not just public investment in energy, but private investment. And I think a lot of these companies are very willing to see this transition through. So I hope that the focus isn't just on profitability, that we look at the supply-demand economics, we look at investment decisions that are going to have to be made in order to provide energy security for America in the future.
Within the commodity complex, both food and fuel, the upside over the next 3 to 6 months is substantial. Our target end of year is $130 a barrel on Brent. And that's because physically, the market is in a deficit still. The pullback in prices will stimulate more demand, similar like you're pointing out with interest rates, back down to 2.6%. The financial conditions have eased somewhat. That's the same thing with the oil price, creating more physical demand. We estimate you could create another 1 million barrels per day of demand on top of an already deficit. And then we haven't even factored in the SPR is going to go away in October, which is another loss of 1 million barrels per day. So we would argue in energy, the upside potential to reach new highs in the second half of this year is still very, very high.